Fantastic. Thank you very much and welcome back. We're delighted to be joining this panel discussion. I am the moderator, and it's trying not to get carried away, which I think is a play on words to do with the private equity industry. And we have a formidable panel here in the form of Annette and our very own Robert. And I will ask in that order for them to introduce themselves and tell us which organization they're from and what do you do day to day?
Happy to. Just realize that Brexit was inevitable because of our different standpoints on using air conditions. So anyway, my name is Annette Meyer. I'm with Allianz Capital Partners. It's one of the asset managers of Allianz. And we are dealing with the alternative assets investment of Allianz and third-party investors for with Allianz Capital Partners and Allianz Global Investors. We invest in infrastructure directly or through funds, in private equity, that's why I'm here, and in debt, debt also directly or through funds. We have roughly 90 billion assets under management, and 1/3 is private equity. And my team and I, we service the full range of that. So we're dealing with the transactions. We're also designing the funds for our third-party clients. And of course, we're dealing with all the tax matters during the asset management phase for our assets. We're based in Munich, but there are also offices in New York and in Singapore and London. But I'm glad that I'm here. Thank you, Ali, for having me.
You mentioned the cities where you're based in. No offices in Frankfurt?
Oh, yeah, we have Frankfurt. Yeah, it's true. Even part of my team is there. So
okay.
If some of them listen in, sorry for that.
Robert.
Yes, my name is Robert Welzer. I'm a partner with the WTS Germany. I'm based in Frankfurt and more or less tax advisor or lawyer and tax advisor since more than 30 years. And therefore, let's say the cultural shifts which took place here in tax structuring and up to the I haven't reached this level yet, tax integrity. I recognize a very interesting phase and more or less what we are advising, let's say the colleagues and sometimes myself, all asset classes, also banking, operational taxes, securities lending, securities industry, and also alternatives, digital assets. That's our core business up to a certain degree.
Excellent. Thank you very much. So we have, as I said to you, most August panel here. And before we dive into some of the tax discussions, if I may, particularly given your expertise in it, and you see so much by way of transactions and so on, if you can perhaps share with us, a bird's eye view, of big picture view of where is the private equity industry? Where is it going? Where is it evolving towards?
Yeah, happy to. A bit of caution. I'm the tax woman here, not the deal team. So they might have a different view. So it's my personal comments that I make. And I also make them from an investor's point of view, how we see or how I see the PE industry looking also at our portfolio. I mean, we are living in a very volatile world, and I think that has been mentioned time and again today. Someone, I think it was Abba, used the word of predictability. She wished for more predictability. I would also say so many things that are happening are so unprecedented, starting with the financial crisis, then COVID, the war in Ukraine, last weekend, the terrorist attack on Israel, and you can name so many things, and all above there is the climate threat, the climate change. So we live in this very unpredictable world. Some say it feels like running from crisis to crisis, and you see it in the capital markets. But at the same time, looking at our PE portfolio, it's very stable, and you don't see these shifts there so much. And at the same time now, when interest rates rise, of course, immediately the questions come, one of them being, is PE now necessary? And also, is it now too risky? Because high interest rates, of course, are difficult for the portfolio companies. And at the same time, people say, well, you could invest in bonds. They might be less risky. Why wouldn't you? And so you can also see that in a shift of the concern of investors into private equity. I think probably a couple of years ago, the big fear was the rapid GP scaling. This fear that funds, successor funds come in too quickly, there are too many deals, the funds are super big. Will there be enough resources to really look after all the investments that were made? And when you now look at what is a big fear of us as investors, it's probably slow pace of exit, because transactions are so much more sticky, and we can also see that in the direct investment sphere. And of course, unrealized write-downs. You never know what there is on paper. Everything is moved forward also by dried up cash pools. So looking at insurance companies, they see that risk capital has become so much more expensive. And for others, it might be that with falling capital markets, your private equity quota is just too high. So we see less numbers of commitment, but also much lower commitments over the board. And when you look at the GP side, there is quite a dramatic decline in fundraising momentum. If you compare 2019 figures, raising a fund, the majority of funds were closed in lower than a year. And now in 2023, you compare the figures, the majority of fund closings take at least 1 year or 2 years. So quite a shift here. Yeah, I already mentioned deals take much longer. And the funding gap that I mentioned from dried up pools, to some extent, it might be picked up by cash from the Gulf. But how I see it, this is mostly something where the big GPs, the big global GPs benefit, but the European and the mid-cap GPs probably not so much. We come from like 10 years of free capital, and you could free money, I must say, and PEs outperformed public markets time and again. So when we looked at our portfolio, I said it's pretty stable. So maybe the valuation multiples came down, but still the operating results from the portfolio companies are really quite high. So far, all in all, not a lot of change. But I guess there will be a change in portfolio focus. What you now need as a GP and what you want as an investor in PE is probably portfolios who can offer you good returns without cheap and abundant leverage. And that will, I think, be key. And I think also as investors, you will look much more on realized gains that you actually get. Looking at that and coming back to Allianz, I think it aligns with what we were doing quite a while. We are investing in PE since 25 years, and we've invested every year. So our portfolio is quite broad and deep, but we've never looked at those who were the best, but always for those who are stable, who provide stable returns. I think, and I don't want to take up too much time with this overview from my point of view, we are rapidly moving into more of an LP, an investor market. When I compare side letter negotiations 2 years ago and now, it's different. 2 years ago, they would say, well, you don't get a side letter, or maybe you get 1 or 2 requests, especially when you come from Europe, because European investors in the global GPs are often the smaller ones. And this already has changed, and this comes at a good time in terms of, and I think this is something we will go into a bit more deeply. We need transparency of what the GPs are doing. We need to see the structures. We need to understand them, because a lot of the tax laws that we face, particularly in Germany, with a CFC taxation, where we are actually asked to go through all of the structures deep down into the portfolios. We need information from the GP. I think there is a shift there, that our requests are heard and get confirmed. So let's see how that develops. But I'm a bit optimistic here. And I guess the whole environment gets a bit more complex. I always think everyone can do easy, but it's now about those showing off who also can do complex to survive in that.
So very interesting. Let's say I'm a typical tax guy, so therefore it's not up to me really to make comments on the macro economics of, let's say, the investment industry of private equity. But 2 remarks might be allowed. Larry Fink from BlackRock addressed, I think it was last year, let's say, that ESG will be the biggest capital arbitrage opportunity of the century. So we see, let's say, funds are investing in ESG or ESG alike. Others are taking the opportunities of dirty assets. So you see, if we talk here about an industry which have different interests, entrepreneurial spirits, and these entrepreneurial spirits, I think, are also tested in the tax arena. But one very interesting comment was, you know, the Biden administration, Ms. Khan from the FTC, Federal Trade Commission in the US, who really indicated probably we have to treat from a antitrust policy the very big fund managers differently, so that they, from an antitrust, let's say, policy, might be treated more like as a let's say, consolidated enterprises. And there's already the idea out of the bottle. Let's say, if these ideas purely from antitrust policy will resonate in the tax environment, and this is just a question of time, it will have very significant repercussions. This is my personal risk assessment. And also ESG, we just talk about, let's say, long-term investments. We talk governance, integrity, etc. But the overall EU concept currently, I would phrase it as nudging investors to invest ESG within ESG conformity. If, let's say, this will not work, probably the tax as a tool to change behavior will click in a different layer. And if long-term investments, let's say, you have to face this as additional risk on the long-term investors. But this was very abstract. So probably addressing a little bit more the.
Absolutely. I think, and that probably sort of like, it's interesting what Annette, you were saying about the greater transparency that GPs are now affording structures. And some of that transparency may be tax driven. So I think, Robert, it may be useful just to sort of like talk a little bit about some of the regimes, other tax drivers that are driving the sector.
Yes, we can address this. Let's say a lot of the tax regimes which I discussed, and this had also been addressed today, very often they are, let's say, addressed on a silo basis. But if we take a look back, let's say when I was a younger advisor in the 90s, and let's say tax structuring was the hype. So the idea was just how to get the best optimized after-tax returns for the investors, and especially the private equity industry with its M&A transaction and so on. They, let's say, provided many opportunities. We, at this point in time, our team, I labeled them the 3F team, fiscal freedom fighters. You see, from an ethical point of view, I have, let's say,
to go.
a way to go. But I think, and this is currently reflected, let's say, talk and resonating the tax integrity. But if you look on the international tax, let's say, scenery, you have a very diverse, contradicting tax regulations, especially in the international context. And if you talk about either, let's say, trading desk with investment banks or a very smart asset managers, if there's out there the opportunity to optimize, why to be so dumb and pay more taxes than it's required by the pure wording of the law? And the pure wording of the law, very often it's, let's say, what is driving what is possible, how to structure that is legal, whether it's legitimate or whether it's ethical, rules-based or principle-based, the best way, very critical. And
maybe if I just can jump in once, because that is something, I mean, I heard that end of the 90s, beginning of the 2000s, that was sort of how it functioned. And then you didn't hear it anymore. People didn't mention words like tax avoidance, tax efficiency is already not a good word, optimization, it's all a bit difficult. But interestingly now, when we are having these negotiations with the GPs, there is this notion, maybe not everyone's spelling it out, but saying, well, you know, in a world now with DAX 6, Pillar 2, maybe ATAD 3, you name it, there is a globally regimes are established that help to maintain a certain tax level, and everything else, what you can do, you can do. So that sort of fits into what we talked about tax integrity. It's something that everyone needs to bring to the table. And I mean, I strongly believe that in an ideal world, we would have sufficient and appropriate tax at the portfolio level, at PE, where value is created, and you have sufficient tax up at the level of the investors. Ideally, the pooling mechanisms in between that pool, on the one hand, the portfolios, and on the other hand, the investors, there should be no tax leakage, because nothing really, apart from the pooling, should happen there. And but transferring that into the real world gets extremely difficult. And this is why then I think GPs have to think about, well, if I can't avoid that in between there are these multiple layers of tax, I need to make the the whole picture right again, so that overall the same text comes out. And so if I can't avoid it here, then I have to cut down here and maybe find ways of cutting down there. And that is again then a shift to behaviors that we probably don't want to see. But sorry, I just wanted to jump in.
That is really an asset. What we try to address is, let's say, the text structuring engine of the 19th definitely had been now addressed by the, for example, here the EU. I will talk a little bit more in detail, due to the fact that, let's say, that national or mutual agreements between the various jurisdictions is very difficult. That, for example, in Germany, I'm quite open-minded, colleagues here or people who know me, let's say more or less the German fiscal high court, they disrupted, let's say, beneficial ownership concept, GAR concept, the CFC calculation, and so on. So even on this level, there is no clear guidance what is principle-based any longer. So it has been completely disrupted by the fiscal high court. And now it's been, let's say, cleaned by the other courts, penalty courts, etc. That's my personal remarks in this respect. No, it has been clear that, let's say, the text structuring engine has to be changed. And therefore, I thought the EU quite smartly implemented various regimes. And if you look through how they structure it, and they will very significantly change, let's say, the text structure, already changing the text structuring engine of the private equity industry. If you go back to the 90s, of course, we have, let's say, a different treatment of equity and debt, let's say, whereby you, on the, let's say, investment level, generate no taxes at all. Then you have the flow-through vehicles, and ultimately, through all the structures available, if you hit German taxable investors, they have their own issues. But if you hit, let's say, non-taxable investors, perfectly. And so it was a really good alignment regarding the net asset value between the, let's say, GPs and the investors, let's say, to increase the NAV via complete eradication to reduce taxation to zero. And let's say, to be quite aggressive, this reduction of any taxes, let's say you have a typical tax rate of 15 to 20%, it resonates somehow with the hurdle rates for the carry interest. And don't be carried away. Let's say what we see now with the changed, I will address this. Sorry if I'm talking too much. You have to interrupt me. I like these topics, and that's really a problem for me. No, and if you have, let's say, now with this tax engine being modified, you will the jurisdictions, of course, they will grab part of, let's say, the return, and therefore this is very often not in alignment with the investors, with the interest of investors, and with the interest of the GPs, with interest of, let's say, good citizenship. Yes, and how the EU really addressed this, from my, let's start with DAX 6. It's about transparency. You have this complete different tax regimes in the various jurisdictions, how to play this to get their transparency. Then you have, let's say, the qualification of instruments with ATED or non-taxable instruments, how they are treated. So ATED 2, passive CFC regulation. Now, then the in-between entities, substance. Is there the question, if there's no substance, you have no entitlement any longer? Let's see how this will be implemented.
But, you know, just coming back to the first one, you mentioned DAX 6. I mean, it doesn't play a role in the PE context, or I don't see it. I mean, we do see some things happening in Luxembourg, but not so much in the PE sphere.
It's very interesting. Let's say, if I talk to my, in Germany, we had, let's say, 6,000, more than 6,000, I think, the DAX 6 disclosures. If I talk to my French colleague, they told me, and I asked him twice whether this is correct. In France, they had 4. So you see the difference between the jurisdiction, the adoption, but at least probably the tax authorities, because they mingle all the or they consolidate all the information, they get enough, let's say, data, and with data analytics in the midterm run, I think they will come up and made up their minds what might be possible. Then they started, let's say, with ATID 3. Let's see what will be there the outcome. And last but not least, and I think that is very interesting, and this resonates somehow with the, let's say, US approach on a complete different layer, Pillar 2. How much or what is the, let's say, exposure of private equity funds, isolated or on a consolidated basis and so on, to Pillar 2? Because ultimately Pillar 2, with its minimum 15% tax rate, would resonate, let's say, that on the level of the investments, some tax should be due. And therefore, the carry might be took away ultimately by Pillar 2. I doubt.
I doubt.
Yeah.
As you mentioned, I mean, so far, Pillar 2 might play a role where you have a consolidated fund, but
Yeah.
that's not happening with PE.
Yes.
I mean, that there's different kind of funds or fund of fund structures where you have a consolidation. So I don't really see that currently playing out. But what I guess is, and maybe that is sort of looking into the future or do some crystal ball gazing. I could see that there is this notion that 15% should be the minimum of tax that you pay, also for the portfolio companies, even in circumstances as they are now, where these rules do not apply. And I mean, you can question yourself if you are a corporate group that is fully within Pillar 2. You have to make sure that in every country you meet this threshold. You are burdened enormously, and I can say so because we already did a dry run. It's not fun. And then you have the PE industry and their portfolio companies, and they're just standing next to that and take a look at it. So that won't work, I think. Also from a maybe not reputational, but from the notion how the public sees it.
It's an unfair advantage up to a certain degree. If you are private equity driven industry instead of, let's say, listed, you really see where the differences and where the returns will derived. Of course, listing is something different than non-listed, and a different stage of entrepreneurial or it's a different stage and different level, but nevertheless there is a difference in how this will be reflected. And we haven't discussed it, but with the, let's say, topics of tokenization, and KKR last year addressed that they won at least one of their new infrastructure funds. The fund units will be tokenized. How this might be reflected within, let's say, transparent taxation features will be very, very interesting to see the development, what will be out there. And here within, let's say, we can say it, if there's no alignment in the future for tokenized assets or fund units with non-tokenized fund units, will be fantastic arbitrage opportunities. But this would be potential positive arbitrage opportunities. But what we are addressing here, and I think it's the difficulties that the tax structuring engine is really addressed now from the tax authorities. Of course, a lot of fine-tuning will take place. It is addressed correctly. Do they, from your experience, do they really trigger the right pain points, or are they just, let's say, from my perspective, gathering the information, learning to come up with a more, let's say, better, better founded solution the next years? So they are still in the on the.
I think the problem is you don't have an alignment within a structure.
Yeah.
So the German tax authorities, they take what they can get from the German investors. And what we see in these structures then is double taxation and over taxation, and that is nothing that really that doesn't resonate with me. You can't really do a lot about it. You are. It's like you get squeezed between the different rules. You have domestic rules in the different countries that are, of course, not aligned. You have these multinational attempts on tax from the EU or from the OECD. I already mentioned you have these increase in burden of administration. Sometimes I wonder how much more tax comes out. I mean, we all predict that Pillar 2 doesn't really bring in a lot of tax, but it brings in enormous amounts of work. And sometimes when we are collecting all the data that we need to collect, I wonder that this is a lot of activity that is sort of value free, because you need to do it to be compliant and to be all paper documented. But A, there's not more tax coming out, and B, you have so many resources that you pull into this kind of work in an environment where getting good people who can do the work is anyhow really difficult. And that probably is then the next thing that we see with PE in particular. You have all these many GPs out there. Every one of them has their own way of providing you the data in different forms. So using technology and using more standardized or automated approaches. I'm not even talking about digitalization here. Even in a huge portfolio as ours is sheer impossible. And that's very frustrating, because you end up having to do a lot of manual work. And we need to get to standardization. We also need to get to a point where data quality rises. And here I think ESG, as it stands today, and tax, they move in the same direction, because if you want to adhere to certain ESG standards, you are also need to rely on the information that you get from in talking about PE again, from your GP. Yes, what we, for example, did, we had an outreach program to our existing GPs, our existing portfolio, to check on what kind of ESG standards do they apply. Is it in line with what we think is necessary? Can we help them develop their framework and their thinking? And with new GP to only invest if the standards are aligned. But what we see as really a big topic is the data quality from the portfolios, from the portfolio companies that we get, and the metrics, how they develop that. And again, the standardization.
Thanks. That's helpful. I'm just conscious of time.
No, question. I want to ask a question. I want to ask a question. So
okay, yeah.
We still have some.
Of course.
Yeah, I have to put the.
I was going to always let you go. I just
sorry.
Make it difficult.
No, I think, let's say what you addressed here, sidelined Germany double taxation treaty, and so double taxation of substance. Let's say the overall tax regime, or we are playing very often, from my perspective, in a let's say tax environment, which is not per se, let's say, aligned with all the economic features in a very easy way. And the tax authorities are getting sometimes a little bit more tough at the moment. We see this, that they are following very much their own approach, disregarding what probably in the past had been some of, let's say, general understanding. So the interpretation changes without any change of law. And if you face the risk of double taxation or even the significant risk in the private equity industry, for you know better than I, and you can address this, probably de facto taxation of substance, you have to think about structuring. So the structuring per se probably is not purely optimizing. It's also sometimes a factor, and we see this very significantly in different parts, do not want to elaborate here, really to safeguard against, let's say, very diverse taxation effects. Because if you are in a win-win situation, NAB goes up, okay, you can live with additional taxes. But if you are non-performing, or not even low, but non-performing, and then the repayment of the rest of the capital probably might be treated as taxable income, and you cannot reverse it, that's stupid. That is absolutely not, to tax substance, it's really a problem. No one really addresses this on, let's say, from a legislative perspective, what might be necessary. And if we talk about, let's say, fairness, I think, let's say, fairness is, of course, being a good citizen, you have to be fair. But on the other side, if, let's say, it's not the organization of society shifts in a slightly different way, you have to follow just the rules, to put it this way. And you are, let's say, I do not know Untertan, or should know it, but forget this German word. And no, where's fairness? It's not a one-way ticket, and is very often addressed with this, let's say, quite complicated arbitrage, potential arbitrary regulations within international taxation.
I want to ask a question of Annette off that. But before I go there, I think there's a really interesting thing which you talked about, some of the prior sort of like taxation developments which have made structuring or planning very, very difficult, because even existing structures, you know, their shelf life and whether it's enduring, is it versatile, can it withstand tax authority challenges? I think that whole thing has come into play, and particularly in the UK market, where from the 1st of January, the new UK-Luxembourg Treaty comes into play, and particularly the Article 28 of that treaty, the principal purpose test, is going to be applied. People are very carefully looking at that in a private equity setting. So it's going to be quite interesting how that plans out. One thing I just want to say on the other matter that you mentioned was in relation to Pillar 2. And Liam Stanbridge and myself, we were on a platform 2 weeks ago, and we identified that most investment funds ought to find themselves out of it because of the threshold requirement or the exempt entity status. But generally, I think the industry view is that private equity is potentially in, because the exempt entity requirements may not be met. Obviously, a house like yours, obviously you've done the impact analysis, but we find that a lot of houses just haven't done the thinking, got their heads around what Pillar 2 means. I think OECD published the toolkit yesterday, so it's going to be quite interesting. But most importantly, before I ask my next question,
That's one risk, what's my private interpretation, purely private and not tested and so on. So just an idea. But if the, let's say, intention of the US or FTC that really, let's say, the big fund houses might be regarded as, let's say, entities for antitrust purposes, then you can revisit or look at private equity funds with the GP as a center, as a tracking stock company. And then you would have the whole portfolio very quickly within the this regime, whether smaller fund houses might be then raised to the threshold of 750 million and so on, might be a complete different issue. And the IFRS regulations, especially for funds, I do not have to tell you who write the IFRS regulations, who are the standard setter, who are driven by the standard setter, who are the industry connections. In the past, this had already been discussions in the 90s, how they apply consolidation and so on for other tax regimes, for fund regimes. And always the funds had been very lucky to be out of some of the
I
consolidation
think it's an
topics.
interesting purposive approach because we see a direction of travel from the accounting profession, which we've seen things like IRFIC 23 or the FIN 48 type of requirements that they are getting more and more purposive in their approach. But no session would be complete without me asking a question regarding tax integrity. So things like, you know, we hear the elephant or the elephants in the room are that this particular sector gets a bad press, particularly around taxation. So, you know, thinking about the fairness, responsible, morality agenda, I mean, sort of like, I mean, that's a very difficult, as we say, it's a judgmental exercise. I mean, you're a senior leader within your organization with responsibility for taxation. I mean, how do you go about managing that? The difficulty.
It's not easy. You have to be very careful, in particular with private equity investments. And we, as an insurance company, and this is our DNA, even though we are the asset manager, but that's where we come from, and that's the money we invest. We are very risk averse. We're also, we want to be a good corporate citizen and we want to be sustainable. And I think one of the tangible aspects of that is really paying taxes, paying the fair share of taxes. And when I talk about the fair share, the principle here is to say, well, everything should be taxed once, but once is enough. So I personally don't like double taxation, be it economic double taxation or the real one. It doesn't matter in the end. So we have a lot of guidance in place internally to also govern our investments, and one of them that comes into play with regard to private equities is our tax haven policy. And I keep finding myself as the odd one out when we have the negotiations for transactions, because the GPs always say, you're the only one asking these questions. And I think, how can that be? I mean, there must be more. I think it's maybe the German Insurance Supervisory Act from many years back that had that included, that you shouldn't invest in certain. I'm sure they didn't use the word aggressive structures, but I think the idea of tax havens was in there. And our sort of internal tax haven definition is much broader than that which you can find in recent rules. The tax haven, anti-tax haven tax code, because we say everything that taxes below 10% should inevitably be seen as a tax haven. Now, that doesn't mean that there are no, in PE structures that we invest in, that there are no such tax havens involved. It's a case-by-case assessment to see, does this particular jurisdiction result in tax benefits? Because if it's a partnership entity in the Cayman Islands simply to pool investors, it's not harmful in our view. So you need to take a close look. And again, you are very much dependent on the information that you get. So we hate surprises. And so you invest in something, you did the due diligence, you had your answers to your questions. If further down the line, you then all of a sudden see I don't know, a BVI corporate where substantial income flows through, that's not good. We don't like that.
Thank you. And we all heard, this whole room heard Robert talking about his heady younger days when life was very simple and he was optimizing tax. But since the actions of the German fiscal high court and various plethora of European tax legislation, we find him a more sober, quieter character. Would you wish to say something about your newfound tax integrity approach, Robert?
Well, that's the most.
We are friends, so we can have a little bit of fun.
Question I recognized in many years. Put it this way. I think, and this is let's say how I will ask this, I will approach this. As a tax lawyer, I think tax is always politics, and politics in the current VUCA world is somehow, whether it's fascinating, whether it's disturbing, I don't know, but I find it at least very interesting. And all, let's say, the politics and the issues of politics are very much really culminate in what is the tax regime in the various jurisdictions, how they treat it, and so on. So that is, we are on, let's say, we are on the edge of what is going on in the world and how to position someone oneself in this direction.
So can I just ask you follow on from that? So as a tax advisor, not only you have to have technology, but you have to be cultural scientist as well.
This would be a little bit exaggerated if I look at myself.
I'm looking for maximum effect here.
But let's say if we talk about freedom, let's say when I studied law in the 80s, freedom of speech, etc., everything was let's say guaranteed, no issue at all. The question of how to cope between what is the stake of the, let's say, society and what is your own stake. And there are so many discrepancies within the tax system, how we tax, what is taxed, and so on. It's very critical. And this is, of course, reflected in all these topics too. And I think this is, I'm still struggling and I have not a clear view how the optimized tax regime should look like, or what I would refer as a perfect tax system. And so therefore, because I have no clue how the perfect tax system would look like, I'm struggling whether I can really be fully fledged integer too, because
that's fine.
I'm working.
You're working. You're not finished article yet.
I'm on the road.
Absolutely.
But
Fantastic.
anyhow, it's striving for something. I do fully believe in tax. I think tax is a good thing.
Yes.
If you want to combat corruption, you need a very good tax system and also good implementation.
I completely agree, but there are so many deficiencies and so on in the real world, and how to address this and so on.
One way would already be within one country, and I mean, my example is obviously Germany, to try and avoid these mismatches and unaligned rules, looking, for example, at Pillar 2 on the one hand, saying we have a 15% minimum taxation, at the same time coming with a CFC regime that's overbearing, and where we already see many instances where we again create double taxation, or where you, for example, you tax something in the hands of the recipient, but there is no correlation on what's happening with the ones paying. There is a lot where, because we are no longer principle based, there are, and this is because you mentioned the courts. How can the courts today rule on principles when they have eroded over time in the laws? So they have to do it on a word by word basis,
Ridiculous.
Which in some ways it's not, but oftentimes it is. So the taxpayer, I think, is sort of in between. I think we are far away from a point in time where we have a more more global or even a European approach, but at least within one country, this should be our goal, to also to be brave, to cut down on rules if we introduce something better. If we came up with the idea, this is working better, why leaving the other thing out there? It's like you introduce guidelines in a company. If you introduce a new one, try to get rid of an old one, instead of just piling up.
Well, thank you very much. This has been a fantastic panel. I will, my friend Lynn's going to be on later on, and it was really interesting to have two German advisors talking about tax fairness and so on. I will ask you, when you are on the panel, to share your views on how fair you find the dealings of the German tax authority. But anyway, thank you very much.
Thank you. Thank you.